My name is Jake, welcome to the channel, and today's video we're going to do another Review My Pie video where I review subscriber portfolios. Really the whole point of this is to kind of just interact with all of you and see how different people all across the globe are investing in a dividend growth strategy. Everyone is in a different position in their life. Everyone has a different priority. Everyone has different struggles, has different things going on. And I think it's so interesting to hear a different person's or different perspective on maybe the same topic. And that's the interesting thing about investing is you can have 10 people in a room and you can ask each one of them what their priorities are or what's the best way to invest, and you'll probably get different answers. And one of the things that I think is important is you want to avoid groupthink. If you're not familiar with groupthink, it's when you get a group of people in a room and one person says one thing and then everybody just kind of like nods their head and agrees. And I don't think that that's healthy for when it comes to really driving innovation and really getting, creativity. And so on YouTube, what you'll notice, there's a lot of groupthink where one person will come out with an idea or a video and then everybody will kind of just copy that, or that'll be the norm. Now, I don't think there's anything wrong with gaining inspiration from somebody else, but I think we all have our own thoughts, our own opinions, and we're all in different situations. And that's what makes this so interesting. Everyone is in a different situation, and it really keeps it from getting boring, because if we all did the same thing, life would be really boring. These last couple of weeks have been pretty crazy here in the stock market. Well, I mean, I guess not for me. For me, it's been pretty normal, but I'm sure a lot of you out there that are invested heavier into growth stocks, in particular, high valuation growth stocks, you're probably feeling the pain. I was looking the other day, I think Zoom and Peloton and Palantir, all these high flyer Cathie Wood stocks are just getting annihilated. And I'm looking at my portfolio, I'm just like, well, I'm not really feeling it. I mean, McDonald's and, Procter & Gamble and, Coca-Cola, they're not actually really down. And I invest into boring cash flowing businesses. The type of companies that I invest in, they're not like really high flying, sexy, whoa, like look at me kind of investments. They're kind of boring. And I actually like that because I like the steady growth. And not a day goes by where I turn on the news and something is going on. There's something going on in Canada. There's something going on in Russia. There's something going on. I don't even know. There's so much noise right now. And all I'm trying to do is focus on what I can control. Like right now, I don't know. I can't tell you how much I've been eating in popcorn, listening to all the crazy things going on and, seeing all these videos that the market is going to crash and sell everything, blah, blah, blah. I'm just like, whatever. I'm just investing in the stock market. I'm focusing on what I can control, and seeing all this noise and all these things getting thrown at me, I feel like I'm constantly dodging everything that's being thrown at me. And it makes me feel like back in, in high school playing dodgeball, it makes me kind of feel a little like this.
Unbelievable upper body movement defensively. 4 punches missed with the head movement. This was truly a master clinic.
He's out right now.
Oh my gosh. Oh man. All right. So first off, we're going to go over a dividend growth investing question that I got from a subscriber here. I believe this person is in the United States. Then we're going to review 3 portfolios. The first one's going to be from a 24-year-old here in the US. The second, a 48-year-old here in the US. And then the third, a 35-year-old from the UAE. And if you're not familiar with where the UAE is, the United Arab Emirates, it's over here in the Middle East, part of Asia. When I was living in Germany, I always wanted to visit Dubai and Abu Dhabi. I didn't end up getting to get over there, but I hope to visit them here actually, in the coming years. But yeah, if you're not familiar with it, it's over here. But if you learn nothing else in this video, at least you know where the United Arab Emirates is on the map. And as always, everybody, there'll be timestamps in the description below, as well as the portfolio links will be in the description below. And, I'm not a financial advisor, so don't take what I'm saying as financial advice. It's just merely for your entertainment. And as always, everybody, I don't pre-review the portfolios before recording this video. I'm reviewing them live for the very first time. All right, let's take a look at the question here from Van. Van writes, "Hi, Jake. My name is Van. I've been watching your YouTube video for a while and seeing your investing style inspire me to start my own FIRE journey. I opened my Roth IRA in January 2021. I have about a 15 to 20 year time horizon, and 20% of my portfolio is in the tech sector. And in this year, tech stocks are down and other sectors are up. Should I keep buying tech stocks and get minus returns, or should I invest more into consumer staples for this year? I'll be looking forward to hearing from you. Thank you, Van." Well, Van, this is a really good question, because what you don't want to do is when you're investing, you don't want to chase the market. You don't want to chase returns, right? You look at what happened during the pandemic in 2020, right? All of this new money was going into highly speculative growth stocks, right? The Cathie Wood stocks of the world, right? Everyone was chasing those high returns. They were probably hearing their friend or their neighbor who, was bragging about how much up their stock portfolio is up. And then they win and they're like, oh, okay, well, I'm going to start investing and doing that as well. The key thing when it comes to investing in the stock market is you don't want to chase returns, right? Because usually when you chase something, you have a short-term mindset. And that's how you get burned in the stock market. When you chase something, you are thinking short-term and not long-term. If you're thinking in decades, you can't really, in most cases, especially if you're investing into index funds, I don't believe that you can lose. Or really there would have to be a crazy event that maybe there's a meteor or something, or some kind of Armageddon event would have to occur, for the stock market to be down over a 10, 20, or 30 year time period. The key thing that I would say, if you're in this situation like Van, try not to chase the market. Don't try to chase stocks or sectors. Look at your overall portfolio and your goal, and then structure your portfolio in that way. If you want to have 20% of your portfolio in the technology sector, go for it, right? If you want to have 10% in consumer staples, go for it. Now, I always, when it comes to this, if you're thinking about a 10 or 15 or a 20 year time horizon, what I would focus on, in my opinion, is focus on the things that are most important to you, right? Investing is only a small piece of your life. And so if you know that you have a 15 or a 20 year time horizon, think about what is important to you. Do you want to be changing stocks and buying in and out for the next 15 years? Are you a buy and hold investor? Who and what are you? What type of strategy, fits to you personally? And so for me, when I look at my Roth IRA, I only own index funds, because my Roth IRA, for my wife and I, she has a Roth IRA as well. We invest 100% in index funds. I'm not going to touch my Roth IRA for the next 22 to 25 years, right? And so from 24 to 25 years. And so for me, it's like, why do I want to buy in and buy out of, growth stocks or try to time the market? For me, I would rather spend my time on something else that I enjoy. And, that's why I have my taxable account, right? And so when it comes to your core question, should you change your allocation based off of what the market is doing? If you have a 15 or a 20 year time horizon, I see that as an opportunity to average down, right? If your 20% of your portfolio is down dramatically, well, if you firmly believe in them, in my opinion, it would be then wise, if you have a long-term time horizon, to average down, because you don't know what the market is going to do a year from now, 5 years from now. And so by dollar cost averaging into high quality investments, I don't believe your average person can lose. Now, if you're looking to pick individual stocks and you're speculating, and you have a short-term time horizon and you're buying in and out, that's how most people lose. And so if you want to set yourself up for success and you feel that you're an average person, like me, I'm an average person, I think understanding your strengths and weaknesses, and that the house is against you, like in Vegas, if you're planning in a short-term time horizon, trying to get in and out of stocks. So that's how I would approach that. I hope that that's helpful. And if you have any other follow-up questions, shoot me an email. I'd be happy to respond. All right, let's take a look at the first portfolio. It's from Howie. He writes, "Hi Jake, my name is Howie. I started watching your video about a year ago, and it definitely gave me a new perspective on how to invest. I consume a ton of personal finance content, read a lot of books, and I'm quite financially literate since I have an accounting and tax background, but I acknowledge there's a lot that I don't know out there. My background is I am currently 24 years old and work a stable job with consistent raises in New York City. I own a condo and have 3 years of contributions in my Roth IRA and 1 year in my 401k. I like to say I did quite well during the pandemic with my growth stocks, but I've recently sold out of all individual growth stocks on my Robinhood account to afford the down payment on my home. I just started my M1 Finance account on the Dividend track and would like to make consistent contributions to retire around 50 to 60 years old, depending on financial circumstances and where my career goes. I understand that my taxable account only has 22 holdings, but I set aside half of my portfolio as dividend and dividend growth ETFs to increase the diversification and only include tech, REIT, and individual stocks that I believe in and like to own more of. I definitely would appreciate your advice on this. Thanks for your time and best of luck on your YouTube channel." Well, Howie, thank you so much, man. I appreciate it. First of all, you're 24 years old and you live in New York City and you can afford a condo. Man, that is incredible. That is really, really great. All right, let's take a look at your taxable account here. Your portfolio is up 121%. This is really good. And you have over a 2.3% dividend yield. So your performance, you're actually beating the S&P 500 from a total return perspective with the dividend and the total return, and you have a very low expense ratio. And you have 22 holdings. This is a very manageable amount. I actually really like this. And so you have 50% in dividend ETFs, you have technology 20%, individual stocks 20%, and real estate 10%. Okay, so right off the bat, if you know your time horizon is and you know you have a Roth IRA, the first thing that I would encourage you to consider, why even put real estate REITs in your taxable account? If you have a Roth IRA already, it may make more sense to put the REITs in your Roth IRA altogether, but we'll take a look at that. So that's the big thing that I would say off the bat. The REITs, if you don't have to, you may want to consider putting them in your Roth. And the dividend piece, the ETF piece of this, I really like ETFs. I really like dividend ETFs. And I will be honest, 4 years ago when I started watching dividend videos on YouTube, I watched videos from PPC Ian, right? A lot of you following this channel know about PPC Ian. And you know that PPC Ian disses on ETFs. And so I've originally thought, if I want to retire off of dividends, I have to do it through individual stocks like Ian. Actually, no, you don't. I think actually most people would be better off investing into high quality, low fee ETFs. That's my honest belief. And I will talk more and more about that on the channel going forward. But that's something that I hope if you're a new investor, a new dividend investor, and you're thinking, okay, do I go ETFs or do I go individual stocks? I think in most cases, ETFs are going to be better for you, but you have to pick the right ETFs. Just like there's bad individual stocks out there, there's bad individual ETF or bad ETFs out there. So really, really important. All right, let's take a look at your ETFs. You got VTI, perfect. VYM, SHD, DGRO, and SPHD. All right, I like all of these. I think SPHD, to be honest, I don't think you need it. Personally, the expense ratio is a bit higher on SPHD. The yield is 3.4. But the reason why I don't like SPHD is if you look at the individual holdings, when you compare SPHD to like VYM or SCHD, I like the holdings more in these others, and they're less expensive. And it may pay, I'm almost positive it pays a monthly dividend. I'm not going to take a monthly dividend of an ETF just and sacrifice maybe on the growth or the quality just because it pays monthly. That's for me, like that's not really the right approach, at least for me, right? So that's the one thing, that's just my opinion. VTI is great because it adds stability, right? If you really are a sophisticated investor, you understand beta. And with the total stock market, you're going to have a consistent beta. Beta is the volatility. You're not going to have a lot of volatility in this portfolio. Now, if you get into other speculative high growth stocks, then your beta is going to be really high. That's where you're going to see those massive fluctuations. And so I really like this portfolio. Obviously, in terms of a disclaimer, I own 4 of these. I own this, and this. I don't own SPHD. So obviously, if I own it, I probably believe in it, but I think these are great ETFs. This is a total US stock market. This is a high dividend. VYM is different than SCHD, and DGRO is different than these 3. And the allocation, this is the only thing that I would probably consider is maybe consider lowering VYM and SCHD and bumping up DGRO a little bit, because DGRO is growing a little bit faster than VYM. So that's something to consider. But as a whole, like really, really great ETFs, and the allocation is good. Let's see, what do you got in technology? You got Apple and Microsoft. What is the, 10% in Apple, 10% in Microsoft. If you've been following the channel and you've watched other Review My Pie videos, I don't like this. I don't like this because 10% in an individual stock, though these are really great companies. I love Apple, I love Microsoft, but for me, it's just too risky. Why put 10% of your portfolio in one single company? I personally wouldn't do it. I would take an ETF. This is just my opinion. I would look at VGT. VGT is the Vanguard technology ETF, and the largest holdings of that ETF are Apple and Microsoft. But the difference is you don't take all the risk. If something were to happen to Microsoft or something were to happen to Apple over the next 20 or 30 years, you don't take any of the risk, but you still get the upside because Apple and Microsoft make up such a large portion of that ETF. So in my opinion, I don't like having one stock, one individual company represent more than 5% of my overall portfolio. So that's why I'm not a fan of having 10% into those individual companies. Let's take a look. What you got in here? You got EPD. Okay, you have an oil company. Well, I'm not a fan of that. Target, Costco, good. Coca-Cola, good. Bank of America, fine. All well-known established companies. So here's, right off the bat, I like McDonald's and Pepsi way more than EPD over the next 20 plus years, based off of kind of what you're saying. I like Costco more than EPD. Like EPD, me personally, do you really feel that EPD is going to outbeat Pepsi or Costco over the next 20 or 30 years? I personally don't, but I could be wrong. I don't know. I could be wrong, but I believe that Pepsi and Costco have a brighter future than oil over the next 20 or 30 years. In the short term, yeah, oil is doing great, but what's it going to look like in 20 years? Once again, I don't know, but that's the one thing that I would take a look at. And really quick, you will see if you lower EPD, your dividend yield will go down. Your current dividend yield will go down, and that's not a bad thing, especially if you don't plan on living on the dividends for the next 20 or 30 years. This is actually hurting you from a taxation standpoint. Having these higher yielders is actually hurting you because you're paying taxes in a taxable account all the way until you start living off of the dividend. And so just straight off the bat, it's not going to be the best approach in my opinion. Now, I will say I haven't looked into EPD for a while, so there is this one thing. I can't remember if maybe somebody in the comment section can help me out with this. I'm not all knowing. I can't remember everything, but I'm not sure if EPD is an MLP. Is it an MLP? I can't remember the taxation on EPD. There may be some nuance there. It may be different than Chevron or Exxon. So maybe somebody in the comments can comment on how EPD is taxed. I can't remember I can't remember exactly. But yeah, so that's my thoughts there. In the short term, I think it's fine, but over the next 20 or 30 years, definitely something to take a look at. Real estate, what do you got? SCHH, I actually like that. I like that. Realty income, I like realty income, and I like stack. Yeah, I think this is fine. What I wouldn't want to see in here is like 80%, retail REITs. I like seeing more growth in here, and SCHH is actually a good ETF. I personally own VNQ, but this is a good setup. So yeah, I actually like this. Once again, the real estate, you may want to consider it. Maybe you put the REITs in your Roth IRA. Speaking of your Roth IRA, let's take a look at your Roth IRA. You're up 106%, 1%, a little bit of a higher expense ratio, 5. What do you got in here? Okay, so yeah, you can see your portfolio dip here with QQQ, with the NASDAQ just falling off since November. But yeah, QQQ, I think it's a good ETF. VTI is good. The Russell 1000, okay, good. S&P 500 and DIA. Yeah, you're 100% in equities, which I personally like. I'm not a big bond investor. Especially, if you have a long-term time horizon, bonds, in most cases, are not going to be the best route. So obviously, you're doing this kind of similar to how my wife and I are doing it with our Roth IRA. It's not focused on dividends, and so with your Roth IRA, it sounds like you're kind of focused more towards growth, and it isn't a tax-sheltered account. So in 20 or 30 years, you're going to get more growth from these ETFs than a value ETF over the same long-term time period, so that you could always sell out of these, pay zero capital gains because it's in a Roth IRA, and then reposition them into a higher yielding investment. So I actually really like that. The one thing that I would maybe consider is international exposure. You don't have to, but it's something that you could definitely consider. I don't like putting a lot in international because, the S&P 500, every company in there in some way or another is exposed internationally, but you could look at an international ETF if you wanted to, just, if you really wanted to diversify across the globe. But yeah, thank you so much for sending over your portfolios. All right, the next portfolio is from Ken. He writes, "Hello, I love your content and would like your thoughts based on my timeline to retirement. I'm currently 48 and would like to retire in 15 to 20 years. 15 would be nice, and have a separate IRA with roughly $135,000 from a previous employer. I did jump on the speculative train with Cathie Wood and now sitting on a loss in that investment of 10K. I think you even sent this over before the new year. And so you're probably down a lot more by now, because now it's towards the end of February? Yeah, you're probably deeper in the red now. Oh boy. I also did some Motley Fool picks since I paid for the service, and those are projected as long-term investments. I'm planning on moving to M1, and when the move is complete, what changes would you recommend? I can no longer add to this account. I'm wondering if I should go growth until retirement or blend with dividend." Well, Ken, so I guess the first thing is you live and you learn, right? I don't think you're alone when it comes to getting burned with Cathie Wood or growth stocks. I think right now, the pandemic, Cathie Wood was in the spotlight. She was hailed as like this great, the most innovative and smartest investor in the world. And now, not even 2 years later, she's like hated across the board. I don't know. The market is not forgiving, I'll tell you that. So when it comes to the blend and the strategy, my recommendation here is do the math. Look at the math, understand compounding rates, understand the rule of 72, and look at what approach fits you personally. And most importantly, you're at that age where you're 48. The best thing that you or anyone can do in that age bracket with that time horizon is maximize your tax advantaged accounts. So that being your 401k, your Roth IRA, your HSA, whatever it may be, you're at that age where your tax advantage accounts should be front and center when you're looking at your strategy and building out your portfolio. So that's the very first thing. So understand the different account types, understand compound rates. So if you don't understand that, just do a quick Google search. Rule of 72, very, very important. But let's take a look at the different companies that you have in here. Whoa, we're going to zoom in here. All right. So you got Zynga, you got VC, you got Pinterest, you got MGP, you got Ultra Group, you got the ARK ETF. Hot dang. This was before the new year that you sent this, and you're down 21%. Oh man, dude, you're probably down like 40 or 50 or 60%. Oh man, I'm sorry. Oh man, VYM, Five9, Microsoft, and QQQ. All right, so it's experiences like this that make you think, okay, can I beat the market with picking individual companies or can I not? Right? And so every investor has to learn for themselves, right? Remember as kids, you probably don't remember, but when you were a kid, your mom or your dad was cooking on the stove. And what is that old saying? Don't touch the stove because you're going to get burned. And as kids, we don't know any better. And so we touch the damn stove. And what happens? We scream and we start to cry. Right now, I'm sure that's happening to you right now when you're looking at your portfolio. You're probably screaming and crying like a little baby. But, you know, that's life. But I guarantee you, you're probably not going to do this again. You're going to learn. You burnt your finger. You found out that it's hot and it's not fun. And so a lot of times we have to go through these horrible experiences to learn. And that's what we call this wonderful thing called life. So I guess at this point right here, you have to understand if you don't learn anything from this, then you're just going to do it again and so be it, right? That's life. But if you're smart, you can understand, okay, you may not be able to beat the market, so it may make more sense to revise your strategy or how you view investing, right? So I had my wife on the channel a couple of weeks ago, and she made this comment. She grew up in Germany, and in Germany, she always grew up fearing money, right? She was afraid of it. And then when she came to the States with me, and when she learned more about money, she learned that money can actually be your friend. It can be your friend. So, but you have to be wise about what you're doing, right? And you have to understand what you're doing. Okay, so I guess the thing that I would say here is understand your goal. If you have fun investing in individual stocks and you want to ride the ride, you know, you want to ride the wave and go up and down, you want to have that emotional roller coaster, go for it, right? You're getting to that point or that age where you're 48 years old, man. Like life is going to be passing you by quicker than you know it. You don't want to be one of those guys by necessity, not by choice, that has to work at 70, right? Or 68. Now, a lot of people do work because they enjoy it. They do it because they want to get out of the house. You don't want to, if you can help it, you don't want to be the person that is working into their mid-70s because they have to, right? I can see myself working in my mid-70s so I can get away from the house to get out of, not to see my wife every day. I can imagine it. Hopefully she doesn't watch all of my videos, so she probably, I'll know if she watched the whole video of this video because I'm sure I'll hear something about it. But yeah, so you want to put yourself in the position where you understand your emotions and you understand how you're going to react when the market is going up and when it's going down. The big thing here is use this as a learning experience. And when it comes to the investments here, they're not really crazy investments. Maybe the timing was off, right? You bought ARK at the high. Okay, you were chasing, right? You learned there. The reason why I always focus on dollar cost averaging is because I don't know when the bottom is and I don't know when the top is. And so I don't even focus on timing it. I just focus on how do I get as much money on a weekly basis into the portfolio. That's all I care about because I acknowledge that I can't time the market. And so I try to focus on what are individual companies that I believe in, that I'm going to invest in for the long term. And if they go down, whatever. If they go up, whatever. And investing into high quality ETFs and understanding what you're investing in. And the key thing here is you have to understand that you're investing into a business. Not all businesses succeed. Some businesses fail. And that's why over a long term, I really like ETFs because your normal person like you and me, in most cases, we can't always pick the winners. Right? And that's why I'm a huge fan of ETFs. I really like VYM. I really like SCHD. QQQ is great for the long term. I think that's great. But it sounds like you need to potentially reassess, some of your goals, some of, what's important to you and how, putting it pen to paper, your investment strategy, and really sticking to it. And when the roller coaster comes, you're able to hold on. So I hope that that's helpful. Ken, thank you so much for sending over your portfolio. All right, the last portfolio here is from Saad. He writes, "Hey Jake, I love your channel and content." Oh, thanks, man. Appreciate it. "I'm 35, expecting dad." Oh, nice. "And I'm a new investor." So you're a new investor and you're expecting a little baby boy or girl, whatever. That is so cool. "I currently live outside of the US and have a broker company which helps me access investing. There's no tax here in the UAE. And I invest monthly $400. I do have debt, but that is already being financed by itself, so no worries there. For me, retiring will be at a normal age around 60 to 65 years old. I'd like to send you my portfolio sample. Now, my strategy is mainly to be a growth and income investor. Now I know you're not a financial advisor. Thank you for pointing that out. But because I value your opinion a lot and would really like to have it. I'm sorry that M1 Finance, which I like, is not available in UAE. And I use a local brokerage, so I'm going to be sending you an Excel sheet reflecting what is invested. Hope to hear from you soon. And by the way, I've been investing since August of 2021. Okay, well, very cool. Well, first off, shout out from Texas. That's awesome. It's exciting to hear that other people, across the globe are following the channel, and appreciate the kind words. And I'm sure you're going to be expecting a little baby. That's fun and exciting and stressful and all the fun stuff that comes with that. All right, let's take a look at your portfolio. So it looks like you have a couple of columns here and you have it broken down by your distribution, your allocation, and by sector here. So your main holding is the total stock market. That's probably an ETF. I like to see that. You have staples in here. You have cyclicals, materials, technology, REITs, healthcare, financials, communication, energy. Okay, this is actually really cool. The reason why I like this is that you've been very methodical when putting this together. You haven't just thrown it just at random. It looks like you're very detail oriented and you really want to have an ideal allocation that fits your goals, which I think is great. When looking at the allocation itself, you're not crazy in just one sector, right? You have 18% in technology. I think that's fine, especially given your time horizon. Having a ton in the total stock market, you're obviously going to get exposure to everything, which I think is really good. Let's take a look and see what you have. We'll take a look at the chart here and then we'll go to the right next. So you got VTI, okay, the total US market. There's actually total world market ETFs as well, not just the US. So if you're interested in the total global market, not bonds, just companies across the entire world, it's just ticker VT. It has a little bit of everything. But let's take a look. So you got Apple, you got AbbVie. Okay. All right. So you have it broken down fairly consistently. Let's take a look at over here. So you got Apple just over 5%. I think that's fine. You got AbbVie, you got Abbott, ADP, Aflac, AMD. Okay. Amazon. So you got a few growths. Well, Amazon's at 0. So I guess you sold out of that. ATO, Bank of America, Chevron, Facebook, Google. Okay. GSK, I can never pronounce this. I know how it looks. I can never pronounce it for whatever reason. Home Depot, Johnson & Johnson, nice. Coca-Cola, 3M. So you got your traditional US companies in here, right? It doesn't look like there's a lot of global companies. Not really. There's a lot of other companies out there in the UK and in the Netherlands, in Switzerland, and Germany, and different parts of the world. Maybe there's, Nestle, other really great companies out there. But yeah, understanding the tax laws are going to be important. I know you mentioned that there's no taxes for your country, but it's very possible that you have to pay taxes on the international tax. So for example, if you get a dividend from another country, what does that look like? So something that you'll want to take a look at, if you're going to pay an international tax. There's a difference between international and domestic. You got realty income, and a lot of times internationally it's broken up separately by real estate and just regular equities. So that's something to consider. Like for example, in the US, I can buy a company from the UK and pay 0 international tax, but if I buy a REIT, a UK REIT, then I have to pay taxes. So there's a little bit of those nuances there that you have to be aware of. You got Pfizer, Procter & Gamble, Stack, Store, United Healthcare, WP Carey, Exxon, AP. Do you have APD twice? ADP. Okay. All right. Got it. No, this is Colgate. Okay, cool. All right, so you got a lot of great companies in here. Well, I think the fact that you have no taxes that you're paying on this, right, I think is really attractive, right? You could have a company like Walgreens and pay 0 capital gains tax on that dividend and, you know, be able to accumulate shares over the next 20, 30 years. I think is really attractive from a taxation standpoint. So I guess the one thing that I would say is you're 35 years old, this is probably a passion of yours. You know, how much time are you spending on this portfolio? How often are you changing it? How often are you changing your mind? And the one thing that I've noticed over the years is I've always sided on, you know, I've always focused on simplicity. I want to make my life simple. I don't want to complicate my life. Now you're going to have a new baby. You know, your life is going to get a lot more stressful. You don't want to have stress from your portfolio. I like keeping things simple. My favorite part about your overall portfolio is VTI. I like how simple it is. As the years go on, you may even consider condensing your portfolio and finding out, okay, well, maybe I want 25% in VTI and maybe I want 25% in just high quality dividend ETFs. And then I have, you know, 10 or 20 individual companies. What I'm getting at is your priorities in life will change. Your emotions will change. And I guess what I'm saying is try to keep things as simple as you can. And that's what's really helped me over the years when looking at building out my portfolio. But yeah, thank you so much for sending over your portfolio. Thank you so much for watching, everybody. I hope that you got something new out of the video. I hope that there was something that you learned, that you picked up on, that helped you in your investing and, you know, how you're viewing and looking at your portfolio and dividend growth investing as a whole. Thank you for watching, and I'll catch everybody in next week's video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.